So one of the most popular questions I'm being asked at the moment is whether you should fix your mortgage or not, and if you do, then how long for? And so what I'm going to do is give you as much insight as I can and some resources to look at so it gives you something to think about. Obviously, I can't give you a definitive answer because it's based on your own personal circumstances, but I think by the end of this piece, you should have a little bit more insight to be able to make a better informed decision. Now, in 2025, around 700,000 UK households will see their fixed rate mortgage deals come to an end, and they will likely see their monthly mortgage payments increase significantly as a result. So if you are remortgaging this year, you are not alone. And the latest Bank of England data actually shows that remortgaging makes up about a quarter of all lending. So the rest is made up of people using mortgages to purchase a property. Now, before I go on, I want to give a quick recap on the different types of mortgages out there. So first of all, you've got the fixed rate mortgage. Now, this is where your interest rate is locked typically for a set period of time of 2 years, 5 years, or even 10 years. Now, this provides certainty for your monthly payments that they will stay the same no matter what happens to interest rates, and more particularly the Bank of England base rate. Then you have variable rate mortgages. So these do vary and fluctuate in line often with the interest rates out there in the wider market, particularly the Bank of England base rate. There are a couple of types. So you've got tracker mortgages. They tend to track the Bank of England base rate plus a margin set by the lender. It sometimes, almost typically, is a bit above the Bank of England base rate, but it can be below. Then you have variable rate mortgages. So these change at the discretion of the lender. So they're not tied to the Bank of England base rate, for example. And when you come off a fixed rate mortgage, you often end up on the standard variable rate that the lender sets. And of course, that is variable and can change at the lender's discretion. So there are also discount rate mortgages which offer a discount on the lender's standard variable rate. They're not so popular, but I've just mentioned them because they are out there. And you also have offset mortgages. We're not going to cover that in this particular piece, but if you have significant savings, you can use that to reduce the interest that you pay on your mortgage. Now, one thing that I'll just throw in there before I move on and talk about mortgage rates is the early repayment charges. These are charges that are typically associated with fixed rate mortgages, but you do get them to a lesser extent. And normally if they are on the variable rate mortgages, they're lower. But what happens, early repayment charges are applied if you try and change your mortgage. So let's say you remortgage, or you may move house, for example, and the mortgage isn't portable, then you can be charged a fee. Now, with the longer fixed rate mortgages, the fee, the early repayment charge, tends to be higher. So to give you an example, if you've got a 5-year fix, then in the first year, you often see a 5% early repayment charge. That 5% is 5% of the mortgage size, so it can be significant. It then typically reduces until the end of the deal period, in which it disappears, and then there isn't an early repayment charge, and you're free to do as you choose without being penalised. With that clarified, moving on to the mortgage market itself. So to make an informed decision about your mortgage, it's important to understand the bigger picture. Now, mortgage rates are heavily influenced by the Bank of England base rate, and the Bank of England base rate is the interest rate the Bank of England charges other lenders to borrow money. The base rate therefore affects the interest rates that lenders charge their customers for loans, mortgages and savings accounts. And in the UK, the base rate has been at historic lows for much of the past decade, and that is until recently. And that was largely due to the Bank of England's efforts to stimulate the economy following the financial crisis. And then we also had the pandemic. It ultimately meant the base rate tumbled down to 0.1% when we were in the midst of the pandemic. But as we all know, things changed, inflation surged. It reached 11.1% in October 2022, which was a level not seen in decades. And to try and control inflation, the Bank of England increased the base rate between December 2021 and August 2023 to a high of 5.25%. Now, that represents a significant jump from the record lows that I mentioned, but it is in fact just below the long-term average. If you go and look at the Bank of England website, you can see the base rate going back as far as 1694. And if you look at the average is 5.9%. So this means that mortgage rates have risen significantly in recent years, and you will see many homeowners are now facing much higher monthly repayments as a result. Of course, it's not just the current Bank of England base rate that influences mortgage rates. You have to bear in mind it's also gilt yields, politics, as well as lenders' access to capital, which starts to move mortgage rates. The point is that the relationship between the Bank of England base rate and mortgage rates is not linear, or in other words, mortgage rates didn't rise in tandem with the base rate on the way up, and they won't do on the way down. Now that the Bank of England has started cutting interest rates after inflation fell back towards its 2% target. If you look at the chart on screen that I'm showing you, you can see this demonstrates the rates for mortgage on 2-year rate fixed deals. And the Bank of England actually started cutting the base rate in August 2024, which is right up here when you look at the chart. But in fact, mortgage rates began falling back in August 2023. And that coincides with the last rate hike from the Bank of England itself. You can also see that the decline in mortgage rates hasn't been in one direction. There have actually been bumps along the way, and that's likely to continue into the future. But I'll give you a tip later on how to limit the impact of that volatility when you're trying to decide what mortgage products to take out. Obviously, part of any decision of whether to fix your mortgage or take out a tracker or variable rate product hinges on your views of where you think interest rates will be in the future and whether inflation will return with a vengeance. Now, while no one has a crystal ball, it is possible to get an idea of where lenders and the market believe the base rate could be over the next 5 years. If we look at overnight index swap rates, which are published daily on the Bank of England website, they give a key indicator of market expectations for future interest rates. So if you go onto the website, you can download it and you can analyze that data yourself. Now, the chart I'm sharing with you at the moment shows you the market's predictions of where the base rate is likely to be over the next 5 years. And the great thing about the data is you can go back and look at past dates, past predictions that were made. And the chart on screen shows you that the most recent predictions are now thinking the base rate is going to stay higher for longer. And it won't actually fall below 4% over the next 5 years, which is markedly different from where we were in August when predictions were thinking that the base rate would fall below 3.5% over the next 5 years and actually would fall to about 3.6% by the end of 2026. But these market predictions are more of a finger in the air that can help inform a decision, but shouldn't be relied upon because they do change quite radically over very short spaces of time. Now, if you are remortgaging this year, what I've said so far at least explains why you are now looking at much higher mortgage rates than the ones that you've got on your existing mortgage. So where are mortgage rates right now? We regularly update the best buy tables to show the best deals that are out there in the market at the moment. Now, if you look at the fixed rate deals, 2-year fixes are around 4.22% if you've got a 60% loan to value. If you've got a 90% loan to value, you're looking at something more like 4.98%. Of course, you've got to bear in mind more than just the interest rate, you've got to look at the lender fee as well. If you're looking at 5-year fixes, then it's 4.07% is the best as I make this video with a 60% loan to value. And then with a 90% loan to value, you're looking at something like 4.56%. Of course, there are 10-year fixes with the best of those being down around 4.44% with a 60% loan to value. But if you're looking for tracker deals, then they are more expensive than the equivalent fixed rate deals. For a 2-year tracker rate, the best you're going to get a 60% loan to value is 4.69%. 90% loan to value, you're going to have 5.04%. So those rates I've read out are the general mortgage rates available to people who are buying a property. They are similar to the remortgage rates out there, but they can be slightly different. So we've actually got a best buy table we'll put a link to in the notes of this video for remortgages, as well as this best buy table that I've shared with you on screen. Now, the upshot is if you've got a 60% loan to value, then back in 2020, which is 5 years ago, the best rates around were about 1 to 1.5%. Now, 2 years ago, that rate had already jumped to around 4.3% on a 2-year fix. Now, currently, the best 2-year fixed rate deals are over 4%, as I've already mentioned. So it means that if you're coming off a 2-year fix and you want another 2-year fix, you won't be probably getting a rate any better than the one you're currently on. So unfortunately, your monthly mortgage payments are unlikely to fall. Now, you might instead think, well, I might look at a 5-year fix to see if there's a better rate there, because fixed rate deals for 5 years have been lower than 2-year rates. But we are currently at the point where the difference between a 2-year fixed rate and a 5-year fixed rate is at its lowest level in 2 years. So it's a marginal decision. The bad news for anyone coming off a 5-year fix is that it means that if you're remortgaging after that 5-year period, then you're looking at a substantial increase in your mortgage rate. It's going to be about 3% from what you're paying now. A useful rule of thumb to remember is that for every £100,000 of mortgage that you've borrowed over a 25-year period, each 1% increase in your mortgage rate will send your monthly mortgage payments up by £50. So that means for the average borrower in the UK, the average mortgage is around about £150,000. A 3% increase in their mortgage rate will see their monthly mortgage payments go up by £225. Now, I've looked at the best rates out there. So if you're remortgaging, I've assumed that you will shop around. But of course, if you shop around and maybe move lenders, there's going to be a new affordability assessment and they're going to look at your earnings, for example. Now, for some people, they may not want that to happen. And so they may instead opt for a product transfer with their existing lender where there won't be such onerous checking and you won't necessarily have to prove your earnings. That is attractive, but it may mean that you don't get the best rates out there because you've got a limited choice from your existing lender. So that's something else to bear in mind. And of course, as I pointed out, I'm talking about the best rates. Uswitch actually have a good roundup of the average rates out there in the market because the rate you get does depend on your personal financial circumstances. They even include on there the best rates across the big 6 lenders because obviously there are some people who would rather stick with a name that they know. So whether you're buying or you're remortgaging, should you take a tracker or fix and how long for? Well, while the answer is obviously dependent on your own circumstances, it is quite interesting to hear what everyone else is doing. Now, the data out there from Mojo Mortgages has shown that in 2024, a staggering 95% of its customers opted for a fixed rate deal, and that showed a clear preference for stability and protection from potential rate hikes. Now, according to recent news coverage out there, over the last 3 months of 2024, 65% of Santander's customers chose a 2-year fixed rate, while 27% opted for 5-year fixes. Now, that's a big shift because previously that had been split 60-40 in favour of 5-year deals. Now, this trend suggests that many borrowers are hedging their bets, hoping that rates will have fallen by the time they get off their 2-year fixes in 2 years' time. The surge in 2-year fixed rate mortgages has even sparked some debate, with concerns being raised about whether borrowers are being properly informed about their choices. The Bank of England conducted a recent study running from 2013 to 2020, suggesting that some mortgage brokers might be incentivised to recommend shorter-term fixed-rate mortgages, as this allows them to earn more commission because the borrowers will have to remortgage more frequently. So the popularity of 2-year fixes is not necessarily an indication of what's the right choice for consumers. It could actually be swayed by what's most profitable for certain people in the mortgage industry. Having said that, I do recommend that you use a mortgage broker because they can find the best deal for you out there based on your personal circumstances, and not all mortgage deals are available directly to consumers. I always use a mortgage advisor. If you don't have one that you know or has been recommended to you, then there is a link in the notes to an article on the Money to the Masses website that will help you find a reputable mortgage advisor near you. But the point is that make sure that you're informed, and when you do speak to an advisor, ask about all of the options and all of the different fixed rate terms that are available out there. So when you're looking at whether to fix or not, you want to look at the pros and cons of each route. So with a fixed rate mortgage, you get the predictability and peace of mind and protection from rising interest rates. But on the flip side, you actually miss out on potential rate cuts, and there are also typically early repayment charges you have to bear in mind. Now, with variable rate mortgages, of course, the pros are the flexibility that you have with them. The early repayment charges tend to be lower. You also can potentially benefit from rate cuts from the Bank of England, which can be passed on by lenders. Of course, there's the uncertainty and the potential for higher mortgage payments if rates do go up, and it's difficult to predict the future payments that you may have in that scenario. Probably the best way to summarise it is that if you want certainty and to protect yourself from potential rate hikes, then fixed rate mortgages are likely the better option for you. And if you're comfortable with some level of risk and want the potential for lower rates, then a variable rate mortgage might be more suitable. It's whether you want to play the interest rate game. And one important thing I must stress, there is no right or wrong answer because we don't know what rates are going to do in the future. You may win or you may lose when you look back with the benefit of hindsight, but it's more important whether you can sleep at night or not. So bear that in mind. If you do decide to fix, then whether you choose a 2-year or 5-year, for example, will depend on your attitude to risk when it comes to interest rates and also your budget. Can you stomach the possibility of rates going up? it's not certain that rates will go down in the future, even though the market predicts that we will see some future rate cuts. Obviously, one benefit of a longer fix is you don't remortgage as regularly, which means you're going to end up paying lower fees. Also, consider your future plans and how your circumstances may change over the term of your mortgage. This will help you choose the right balance of flexibility and certainty that meets your needs. To give an example, if you perhaps plan to move in the next few years, then fixing for 5 years or more may not be the best idea. The early repayment charges may hinder your choices. Of course, you could have a mortgage that's portable, so you could take it to a new property, but there's no guarantee, even if it is a portable mortgage, that the lender will agree to lend on the new property when you get to that point in time. So do seek advice and explain to your mortgage advisor what your plans are in the future. So certainty in terms of payments may be something that is really important to you, but also bear in mind flexibility. Now, I'm going to quickly finish with a couple of tips. Do look at all of the costs when you're looking at a mortgage. Don't just focus on the headline rate. Look at things like lender fees. A mortgage advisor can help you with that. Also, bear in mind that your loan to value will have a big impact on the rate that you do end up getting. So if you are not remortgaging for a period of time, then you may look to pay down some of your mortgage to get a better rate. Something to bear in mind. Also, if your mortgage rate is going up and you may have some money in savings and not enough to shift you from a loan to value band from one to a better one to get a better rate, then you could instead put a buffer in your savings and maybe subsidize your mortgage payments with a small amount from that each month, maybe a few £100s. That way you can optimize the use of your savings that will help you maybe ride out a period of higher interest rates. Mind, as I mentioned earlier, we are around the long-term average for interest rates. And a really important tip that most people don't realize, that if you're getting towards the end of your fixed rate deal, don't wait till it ends before you shop around, because you'll end up on the standard variable rate, which is inevitably going to be more expensive. But 6 months out from the end of your deal, you can contact a mortgage broker and start to look around for a better deal, which you can lock in. And that way, that protects you from rates going up. So once you locked in your deal, it will naturally carry on once your existing deal ends. But not only that, even if you plan to stay with your existing lender, you can contact them ahead of time to lock into a deal that starts when your existing deal ends. And even if mortgage rates tumble before the new deal kicks in, you can move on to those better deals and put them in place instead. And it depends which lender you are with, how early you can contact them. Now, there's an article on the Money to the Masses website where we round up the window in which you can contact your lenders. So, for example, Lloyds Bank, NatWest, Nationwide, Santander and Halifax, you can contact them up to 4 months before your deal ends. Same with Coventry Building Society. With some other lenders, it's shorter. TSB Bank, it's 3 months. HSBC is 180 days, so is Virgin Money, and Barclays is only 90 days. We regularly update that because they do change those windows. So if you found that useful, hit that like button, but also subscribe to the channel. Hopefully that will give you some food for thought when you're deciding whether to fix your mortgage or not, and if so, how long to fix for.